This is Rob Weinberg, and on this channel, we empower people to take control of their futures through expert mortgage, financial, and real estate strategies. If it's your first time here, hit that subscribe button and don't forget to get notified on all of our future content. In our lesson today, we're going to be talking about the art of rate shopping. And it really is an art. Many people actually go about shopping for the best rate the wrong way, and we'll dive into that today. So we're talking about rate shopping specifically in the context of buying a new home or refinancing an existing property that you own. Now, all these different lenders out there have different interest rates. Why? What are the influences that are actually influencing the interest rate? So really what we're talking about is the economy, inflation rates, monetary policy, and the supply and demand of mortgage-backed securities. So when you actually take a mortgage, generally speaking, that mortgage is going to be placed into a security, which is going to be sold on the secondary market to investors. The yield of that security, or how much money they're going to make off that investment, is going to drive the supply and demand for those securities. That will also directly impact the mortgage interest rate that you get. So the mortgage rates take their cues from the 10-year treasury yield. When you see the treasury yield going up, you'll generally see mortgage rates go up. The mortgage rates move inversely to mortgage-backed securities. So mortgage-backed securities, if you look those up and you see those rising, you'll generally see rates going down and vice versa. So those are the influences. No matter what bank you're getting your loan through, we're all getting influenced by the same thing there. Now, pricing can be different, as I said, depending on what lender you go with. So how do lenders actually determine the interest rate that you're going to get on that new mortgage? What we refer to in the industry as mortgage pricing. So the pricing that you get as an end consumer is going to depend on a lot of different factors that go into that loan application. Some ones that you want to be aware of are the loan program. Is it an FHA or VA loan? Is it a conventional loan, non-QM, etc.? What type of loan program are you getting? Your credit worthiness. Obviously, you want to have a higher credit score in almost all cases. So having a better credit score is going to give you a better interest rate on that loan. The loan term. Is it a 30-year term, 15-year term, maybe somewhere in between? Generally, the lower the term is, the lower the interest rate is going to be. It's less risk for the lender. The loan to value, or how much equity you have in the property. If you're buying a home, the more money you put down generally, the better interest rate you're going to get. The property type. So if it's a single family home, it's generally going to be the lowest risk. Then next is going to be condo, and after that, multifamily, 3-4 unit, etc. So depending on the type of property, you may have a different interest rate than if you were to buy a different type of property. A lot of people don't realize that. And the last one I'll touch on here now is property use. How are you going to use this property? If it's a primary home where you're going to actually live there as your primary residence, it's the lowest risk loan, generally the best pricing. And on the other end of the spectrum is an investment property loan or a business purpose loan. That's going to generally be the highest risk because you as the homeowner or consumer, you're not going to live there. It's purely an investment, okay? So that's all going to impact the interest rate that you get. Lenders also have to account for the market conditions and business strategies, like their personal profit margin. Every bank is going to have a different profit margin, which can generally impact that pricing that you see as an end consumer. So if you're getting a much higher rate from one lender, you can generally expect that that lender has a higher profit margin because of the expenses that they have running their business. All right, so that's the information that you need on pricing. What are some tips and things that you can do today to ensure that you get the best interest rate on that new mortgage? So I'd say the first thing is you want to really focus on improving your credit score, because as we've been talking about, generally that higher credit score is going to get you a better interest rate. So having that score up front when you apply is going to make it a lot easier to get that better rate. You also want to have a stable income and minimize your debt to income ratio. That's going to give you maximum flexibility on what exact loan program you qualify for. And sometimes, as we said, certain loan programs will have better interest rates than other programs. All right. So shopping around, this is a controversial topic because you don't want to waste a lot of people's time. So you don't want to talk to 20 different lenders. Generally, you want to get a few recommendations. You want to get a quote or a couple quotes, and then you want to figure out who do you trust the most, who do you jive the best with, and then of course, where are they at with pricing? If one lender is a half a point or higher than the others, then you might want to just push them aside. But most lenders generally should be like within an eighth to a quarter point of each other. You may find it valuable to take a higher rate to work with someone that you know, that you trust, and that can get the job done. Some people are okay taking that higher rate for the certainty and feeling confident. On the other hand, you may not care about having a trustworthy and good mortgage loan officer, so you may just go with the cheapest and the lowest price you can get. And beware, because there's always going to be someone with a cheaper price, and you don't want to waste a lot of people's time. Also, in mortgage, like many other industries, sometimes you do pay for what you get. So that cheaper rate, if it doesn't make it to the closing table, that could end up being you starting over with a different lender because you tried to cut corners, you tried to get the lowest price. All right, so what is the amount you need to put down to get the lowest rate? Generally, it's about 40% down. Okay, if you're putting 40% or more down, you're going to get the lowest interest rate available for your specific program and credit score. Government loans are generally going to be better pricing than conventional loans. There's less overlays, there's less adjustments to the rate depending on your credit score. So be aware that those government loans may be a better choice if you've got a lower credit score. Loan level price adjustments, or LLPA waivers. When you have a lower score, depending on how much you're borrowing and the equity and whatnot, you're going to get a hit to your interest rate. But if you are a first-time home buyer and you make below 80% of the area median income, you may be eligible for a LLPA waiver where they'll waive those extra fees. If you're dealing with a trustworthy and experienced lender, they should definitely know about this, but unfortunately, sometimes they don't. You'll have to bring this to their attention. This LLPA waiver could save you an eighth all the way up to 3/8 of a point when you get your next mortgage. So it's huge. And the last thing I want to touch on when it comes to tips for getting the best rate is comparing loan estimates. Anyone can talk a good game on the phone or by email, but you actually need to get it in writing. The loan estimate is the document that's going to show you if your rate is locked and what the exact rate that they're proposing to you is going to be, along with the fees associated with that rate. So when you're comparing loan estimates, of course, you're going to look at the rate and the APR, but you really want to pay attention, and this is something most people miss, to Section A of the loan estimate. Section A is where all of the lender fees and points are going to be displayed. So even though one lender may be offering a better rate than the other, when you look at Section A, you may see that the fees being associated with that lower rate are excessive and they're not even worth it. Generally, you want to be able to break even in about a 3-year, maybe 4-year at the most timeline when you're paying those extra points and fees. So this is where it really can get difficult to look at it on your own. You want to make sure you've got someone trustworthy to help you go through the loan estimate, and that will really help make sure you're getting the best deal when it's the deal in writing, not just someone told you on the phone. So negotiation, a lot of people wonder, can I negotiate my mortgage interest rate? And generally you can't negotiate the rate. These are businesses, they have expenses. So sometimes you can, but generally you cannot. You'll want to ask your mortgage loan officer about that. But where the negotiation comes in is really structuring the loan, the different point and fee combinations. Maybe they're quoting you a 7% rate with 2 points. Well, what about, could we do maybe a 7.25% with 1 point? We want to look at the different combinations. What's going to be the best for your situation? Are you tight on money for closing? Then we're going to want to go with a low or no point option. If the seller's paying your closing costs, then it may make sense to have a point or two paid, maybe even more, to get you that lowest interest rate, especially if you're not paying those extra fees to get it. So that should give you some clarity on what can and cannot be negotiated and how to go about that with your mortgage loan officer. Strategies here. What are some strategies that you can use for timing the market and getting the lowest rate? So I think timing the market is pretty much impossible as a consumer, so I wouldn't recommend trying to do that because you'll end up getting burned more often than not. This is where that trustworthy partner, that loan advisor, really comes into play, because they're going to be able to have your application and your information ready to go. So when you do hit that interest rate that you're looking for, when the mortgage does make sense to lock in, they're going to be able to speak with you about it and move forward with that process. So work with a knowledgeable advisor and really focus on creating a long-term relationship, not just a one-time transactional relationship, but somebody that you can work with over time and help you stay accountable to your financial goals. Refinancing opportunities, which we'll talk about in a minute here, but that's important to watch so you can strike while the iron's hot when the rates go down to a point where it makes sense to refi. But trust in your team and your professionals that you've brought onto that team to help guide you in the right direction on that. And the last thing we'll talk about, and I saved it for last purposefully, is refinancing a mortgage. So when you're getting a mortgage now, you might be thinking this rate's too high or it's not what I was expecting, the payment's a lot more. Well, what is your out? What is your exit strategy? For most people, it's going to be either selling the home in the future or refinancing. Hopefully sooner than later, we'll start seeing the inflation rates and the mortgage rates come down, as we spoke about when we discussed influences of mortgage rate. And then you're going to see that there's going to be opportunities to refinance the mortgage that you took maybe in the last year or two and save yourself money every month. Anywhere from maybe $80, $100 on the low end to several $100. I've had clients saving $400, $500, $600 a month on their mortgage payments by refinancing. This is something where you're going to start seeing a lot of solicitations in the mail. You're going to start seeing billboards and ads for refinancing. That tells you that you may want to start looking at your options. If you have a really good mortgage advisor who's who's really looking over your shoulder to make sure you're accountable, they should be reaching out for that semi-annual or annual review when they see that it makes sense for you to look at refinancing. So I hope that today's lesson has made sense to you and given you some clarity on the art of rate shopping and how to get the best deal on your next mortgage. I am licensed in Massachusetts, Connecticut, and Florida, and I'm happy to give you a one-on-one personalized consult. Reach out to me by call, text, or private message. My direct line is 860-413-3938. As always, I hope that helps, and we'll see you on the next episode. Take care.